Shein just disclosed an FTC investigation days before its Hong Kong IPO. The investigation nobody knew about Shein confirmed its U.S. business is under investigation by the Federal Trade Commission. This was disclosed in its Hong Kong IPO filing, the first public confirmation of the probe. Neither Shein nor the FTC has specified exactly what's being investigated. Right before going public, the disclosure comes as Shein prepares to list on the Hong Kong Stock Exchange after failed attempts in New York and London. Shein itself warned investors the investigation could carry significant financial penalties. Going public while an active federal investigation is unresolved is a real risk disclosure, not routine language. From $395 profit to $99 loss, Shein swung from a $395 million profit to a $99 million loss in a single year, Q1 to Q1. U.S. revenue dropped 14.3% after the U.S. removed its duty-free exemption on low-value imports in May 2025. China-origin goods shipped to U.S. customers now face tariffs as high as 87.5%. The cheap cross-border model is under pressure. Shein's entire model depended on shipping low-cost goods duty-free. That advantage is gone. Rising fulfillment costs and price increases are a direct response, not a strategic choice. If the industry's biggest fast fashion cross-border seller is struggling with this shift, smaller sellers relying on the same model should be watching closely.